Mortgages are near their lowest rates in almost a year, which has triggered a lot of questions recently. What moves mortgage rates and why? Why are they lower? Why are they higher? Where are they going next? So let's get into it. This is a chart of 30-year fixed mortgages and 10-year Treasury yields. They move in similar patterns. The 30-year mortgages largely follow the movement of the 10-year Treasury rates. So when the 10-year Treasury yield moves up, so do mortgage rates. It's also important to note that the size of the spread between the two also has a big impact on what mortgage rates are. When the spread grows, it can make the relative rates for mortgages worse. Lately, the spread has been shrinking, but it's still historically high, which is why we're still at mortgage rates that are north of 6%. Now, you might be wondering, why is a 30-year mortgage loan following the 10-year Treasury and not the 30-year Treasury? And that's a really good question. The biggest reason is because most 30-year mortgages don't actually last for 30 years. They typically last closer to about 10 years. And the reason is that borrowers will often pay their loan back early because they move or they refinance, and therefore they get a new loan. So where are mortgage rates going next? Well, back to our chart for a moment. The Federal Reserve does not control long-term Treasury rates, which includes the 10-year Treasury. Even if the Federal Reserve does cut rates, and it is expected to, it is very hard to predict where mortgage rates are going to go because they could rise or fall depending on how Treasury rates respond. Thanks for watching. Reach out if you have questions about interest rates or other financial topics, and follow for more videos about the economy.